I'm going to talk about debt today and about how it actually works. And the reason I'm doing that is because I got this wrong myself. When I was 18, I had credit cards, and later on, I had auto loan. And I had a theory about them, which I'd never have called a theory at the time. It just seemed like how money worked. I thought that as long as I made the minimum payment every month, and as long as I had more coming in than I had going out, I was fine. The debt would fall off over time. And I had a picture in my head of what falling off meant, round numbers, because this is roughly the arithmetic I was doing. If I owed $600, I paid $50 a month. Then 12 months later, I'd owe nothing. 12 times 50 is 600. That's the whole calculation. I found out that's not how it works. That's not even close to how it works. And it turns out I'm not the only person who's ever done that arithmetic. These days, I keep saying the same post go around. Somebody says they've been paying off the minimum on their credit card for 6 years, 8 years, whatever it's been, and the balance is sitting almost exactly where it started. Same number at the bottom of the statement, all of these years later. Now, I'm not going to put anyone's screenshot on screen, and I'm not going to quote exactly one of them because I don't know what these people's situations are, and neither does anyone in the replies. But I know why it happens now. I didn't know while it was happening to me, and that gap is a reason that I wanted to make this video. There's one more thing that's going on underneath. The interest is the obvious one, and it's also the one that people explain badly. The other one is inflation. I know it sounds like it belongs in an entirely other video, and I'll get to it in the end because you can't tell whether it's fair until you hold it up against what money is doing today. So we'll start where I should have started when I was 18, which is a document almost nobody opens. The federal government wrote a sentence, and then it turned around and it ordered your bank to print that sentence on your credit card bill. I'll read it the way it's written rather than tell you what's in it. The summary would soften it, and this thing isn't supposed to be softened. Word for word, minimum payment warning. Even if you make no more charges using this card, if you make only the minimum payment each month, we estimate you will never pay off the balance shown on this statement because your payment will be less than the interest charged each month. Never pay off the balance. Not slowly, not eventually, never. As if you could keep sending that payment for the rest of your life and the number would still be sitting there when you were done. That's not a consumer group's pamphlet, and it isn't somebody's opinion column about credit cards. That's regulatory text. It lives in the rule book that governs how credit cards work in this country. And what it's doing is telling a bank the exact words it has to use when it writes to you about your own account. The bank doesn't get to soften it because the sentence sits inside the quotation marks in the regulation. So it reaches you word for word, or the bank is out of compliance. So now somebody in the federal government sat down, worked out that there's a situation where a person pays on time every month, forever, and gets nowhere, and then decided the bank ought to be the one who says so. That sentence didn't come out of nowhere. Congress started it in 2009 after the crash, when it passed a credit card law and told regulators to make the bank put a warning box on your bill, how many months the balance takes at the minimum, what that costs you in total, or what you'd have to pay each month to be done in 3 years instead. Congress went as far as to say on the page it has to sit, so it isn't the small print and it isn't on the back. The regulator wrote the exact sentences, and that's where the never comes from. Today, I'll show you how that's possible. It's arithmetic. It isn't complicated, and almost all of it happens on a form the government wrote and filled in itself. Now, every document I'm working from goes on screen, section number, date visible. So here's the machine, and it runs on 2 numbers. Every month, interest gets added. The card charges you a percentage of what you owe, not a percentage of what you borrowed originally, not of what you spent this month, a percentage of whatever number happens to be on there right now. And every month, your payment pushes the same number back down. If your payment's bigger than the interest, the balance falls. And it falls by the difference between them. If your payment is smaller than the interest, the balance rises, and it rises by the difference. You paid, you were on time, you did everything the statement asked you to do, and the number went up. That's the whole machine. Everything after this is those 2 numbers racing each other over and over for years. Now, the obvious question is why anybody's minimum payment would come out smaller than their interest. And the answer is nobody in Washington sets a minimum payment. There's no law about it. Your banks pick it. Your banks put the formula in the cardholder agreement, and the regulator went and read 21 of those agreements to find out what the formula actually says. Most issuers set the minimum payment at 1% of the balance. Then add on that month's interest, fees, and anything past due. Every issuer sets a dollar floor. Those floors ran from 15 to 50, and the most common was 40, which is 15 higher than it was in 2015. 1% of the balance plus interest. So the interest gets covered. It has to be. It's built into the formula. And the part that actually reduces what you owe is 1%, a hundredth. And because it's a percentage of the balance, it shrinks as a balance shrinks. So the further you get, the slower you go. That's the ordinary case. And the ordinary case is slow rather than infinite. The infinite one is what that opening sentence was written for. When the minimum is a flat dollar floor instead, and the interest on your balance grows past that floor, the payment stops covering the interest. And then you're pushing a number uphill. The regulator has a name for it. The heading in the rulebook says it with no drama whatsoever. Negative or no amortization. So let's look at what that does to a balance. When the regulator wrote the rules for that box, it also printed a picture of a finished box inside the rulebook. A sample statement, numbers already filled in so the banks would know what they were aiming at. It's an official form, which means what you're about to see is the government's own idea of an ordinary account. Nobody's real bill. The government invented a card holder, and then it had to give him a balance. New balance, $1,784.53. Minimum payment due, $53. $1,784. That's not a catastrophe. That's a transmission, or a couch, or one bad month. And $53 sounds like something a person could manage. Then there's a box underneath, where governments fill in 2 rows. The numbers are fixed, the payoff table on the same form. If you make no additional charges, and each month you pay only the minimum payment, you'll pay it off in about 10 years. And you'll end up paying an estimated total of $3,284. $62, you'll pay it off over 3 years, $2,232, which is going to save you $1,052. That's 10 years. On a balance of $1,784, paying every single month, never missing one, never spending another cent on the card. Somebody starting that today finishes in 2036. So now back to the arithmetic I was doing when I was 18 and run it on this account. $1,784 divided by $53 payments. That's about 34 months, under 3 years. The government says 10 years, same balance, same card, same payment, and the 2 answers are 7 years apart. I wasn't bad at math. I was doing the wrong sum. And it's a sum almost everybody does because it's a sum that works on every other kind of debt a person meets first. An auto loan really does divide out like that. It has a fixed payment and a final month written into the contract. And if you make the payment, it ends. That's an installment loan, and its whole design is to walk to zero on a schedule. A credit card has no final month in it anywhere. Nobody ever hands you a date. It's revolving credit, and revolving means there's no end written down at all. The balance just responds, month to month, to those 2 numbers. So the intuition I built on the car loan was fine for the car loan. I carried it across to cards, and that's where it broke. And the total comes to $3,200, which means the interest by itself, the rental fee on the money, nothing actually bought, works out to about $1,499. That's $3,284 with the $1,784.53 you started with taken back off of it. You paid nearly as much for the borrowing as you paid for whatever you bought, say the couch. Then the second row, where $62 a month clears the same account in 3 years. The minimum was $53. The 3-year payment is $62. That's $9. $9 a month is a distance between 3 years and 10 years, and between paying $2,232 and paying $3,284. $1,052, which the form works out for you and prints in the same box. And $9 is $9. If you're at a point where paying a minimum on a card, an extra $9 isn't lying around wanting to be found, and I'm not going to stand here and pretend it is, but that's the shape of this thing the whole way through, down at the bottom. The curve is absurdly steep. So a very small change in the payment buys a very large change in the outcome. And the reason is sitting right there in the 2 numbers. Almost all of that $53 was going towards interest. Almost all that extra $9 goes towards the balance itself. The government isn't guessing at any of this either. There's a whole appendix telling the banks how to compute the 2 numbers so that 2 banks running on the same account land on the same answer. No new charges, the rate doesn't move, the payments never stop. Now, everything I've described so far sounds like a scam. Pay for 10 years, hand over nearly twice what you borrowed. The reason I'm not calling it one yet is there is a completely legitimate reason lenders charge interest. And if you don't know what that reason is, you can't tell the fair version from a version that's eating you. Money gets worse over time. Not your money specifically, everybody's, all at once, continuously. So if you were to lend somebody $1,000 and they hand you back $1,000 10 years later, you've actually lost money on that deal, which means part of any interest rate is just the lender standing still. That's not a trick. That's the floor. And it's the reason a 30-year mortgage can cost far more than the house and still be a fair price. Because across 30 years of prices climbing, a large share of interest total, I'd say probably most of it, is a lender keeping up rather than the lender making money. The government measures how fast money gets worse. The measurement is called the Consumer Price Index. The Bureau of Labor Statistics keeps it, and it's a price of the same basket of ordinary things tracked month to month for decades. Here's what happens when you point that measurement at a credit card. Inflation over the last 5 years has been rough, and everybody's felt it. Measured on the CPI from the 2021 average to this year in July, prices are up about 23%. That's 5 years of the grocery bill climbing on you. Now the card. The Federal Reserve publishes the average rate people are actually being charged, not the advertised rate, the rate on the accounts that are carrying the balance and getting billed for it. Credit card accounts assessed interest at 22.15%. All credit card accounts, 20.94%. 22% on accounts that are actually carrying a balance. What inflation did to the price of everything over 5 years, a credit card does to your balance in about 1. So, no, inflation doesn't explain away a credit card. It explains a mortgage, and it explains why a 30-year loan at 5% isn't theft. At 22%, the balance growing is several times faster than the money is shrinking. So the debt gets more expensive in real terms every year you hold it. Time rescues a mortgage borrower a little. The cardholder gets the exact opposite of that and gets it every month. This isn't a small population either. Credit card balances across the country came to $1.263 trillion in the second quarter of this year. And what got charged in interest on cards during 2024 was $160 billion against $105 billion only 2 years earlier. On top of that, another $31.3 billion in fees. So what actually works against all this? I'll give you what the rules say, which is all I'm qualified to give you. And every one of them is a real enforceable thing rather than a tip somebody thought up. Start with the grace period, because it's the big one, and it's the reason a person can carry a credit card for years and never pay a cent of interest on it. A grace period is a period between the end of a billing cycle and the date your payment is due. During this time, you may not be charged interest as long as you pay your balance in full by the due date. Credit card companies are not required to give a grace period. However, most credit cards provide a grace period on purchases. Now, there are two halves to that, and both of them matter. Pay the statement in full, and the interest never starts, which is the difference between a credit card being a payment method and a credit card becoming a loan. And it's the same piece of plastic either way. But look at the other half. They're not required to give you one. It's in your agreement or it isn't. Then there's a rule about where your extra money goes, which matters if you're carrying balances at a different rate, say a purchase balance and a cash advance. When you pay more than the minimum, the issuer must allocate the excess amount first to the balance with the highest annual percentage rate, and any remaining portion to the other balances in descending order based on the applicable annual percentage rate. Anything above the minimum goes at your worst rate first, and that isn't the bank being nice to you. That's federal law telling it where the money goes. So the short version of all that. Interest is charged on the balance every month. Your payment either beats it or it doesn't. And when it doesn't, you can pay forever and go backwards, which isn't some rare edge case because the federal government saw it coming clearly enough to write the bank's warning about it word for word. There's something you could do about that this afternoon, and it costs nothing and it takes a minute because you already own the document. Go find your most recent credit card statement, the paper one or the PDF in the app, and look for the box headed minimum payment warning. The rule puts it next to your minimum payment due, and Congress said it has to sit somewhere conspicuous. Three numbers live in that box: how long it takes to pay the balance at the minimum, what that costs you in total, and what you'd have to pay each month to have it done in 3 years. One thing that'll save you a confusing minute. If you go looking and there's no box, that's actually good news rather than a missing document, because the regulation excuses in a handful of situations, and the one common one, as far as I could tell, is if you paid the whole thing off, no warning is required for a cycle that comes right after 2 cycles where you cleared the balance, or where the minimum payment would clear it anyway. No box means there's nothing to warn you about. I'm not going to tell you what to do about those numbers because I don't know your situation. I'll just point at the one comparison the government already did for you on its own sample statement. The distance between the slow way and the fast way was $9 a month. And if your box does say never, now you know exactly what that means, and you know it isn't a threat. It's an estimate. Somebody did the math, and Congress made them show that to you. So hopefully this episode helped you understand your credit card bill a little better, and how you could pay it off quicker, and the resources that are available to you. Just write on your statement yourself so you could see what happens. And you could see that if it says never, that now you understand that that means you're paying less than the interest is gaining. And so with that, if this content is the kind of content you like and you found it useful for you, please give me a like. It helps out a bunch. And if you want to, subscribe, and I'll see you in the next video. All right, thanks. Bye-bye.